Welcome back to the deep dive. Today, we are opening the books on an industry that's, well, it's about as non-cyclical as you can possibly get. I mean, demand guaranteed. We're talking about death care.
That's right. It really doesn't matter what the economy is doing, does it?
Yeah.
Recession, boom times, inflation.
Nope, demand stays completely predictable.
It's the ultimate certainty, really. And it's a big market we're looking at here, around $27.2 billion in North America alone.
That does sound large.
It is.
Yeah.
But here's the interesting part. It's incredibly fragmented, lots of small players. But at the same time, it's poised for some really significant long-term demographic growth. The aging population.
Right, the baby boomers. So our mission today, it's really focused. We're zoning in on the undisputed heavyweight champion of this market, Service Corporation International. You'll often hear them called SCI.
The 800-pound gorilla, absolutely. They're the clear leader, holding something like 16% of the North American market share.
So what we need to figure out today is how they manage this. How do they operate such a stable, high-margin business when the entire industry is going through this massive underlying shift? I mean, the move towards cremation is huge.
It's fundamental.
And maybe the biggest question really is whether the market is right to give them such a high valuation premium compared to, well, everyone else in the space. Does it stack up?
Yeah, justifying that premium is key.
Yeah.
And I think to really get that, you have to understand SCI's core approach to growth. We've been calling it the dual engine thesis.
Okay. Dual engine.
Right. Their strategy isn't passive at all. It's quite aggressive, actually.
Yeah.
It combines two complementary ways to grow.
Yeah.
One engine is external.
Acquisitions.
Exactly. Disciplined, accretive acquisitions. They're systematically buying up those fragmented independent operators, just rolling them up.
Okay, that's engine one. What's the second?
Engine two is internal. It's about predictable organic growth at the locations they already own. This comes mainly from, well, leveraging their pricing power and constantly working to improve the mix of services people buy, getting higher value per service.
Got it. Acquisitions plus organic growth. But there's something else, right? The thing that really underpins all of this financial stability.
Yes. The anchor. The number that probably lets their investors sleep very well at night.
Let's call it the big number T's then. SCI has this enormous backlog, estimated at around $15 billion of future revenue.
$15 billion. And that comes from what they call pre-need sales. People arranging and paying for services way in advance.
So it's contracted revenue, locked in. That gives them, well, incredible visibility into future earnings, doesn't it? Years, maybe even decades out.
It's exceptional predictability. You just don't see that very often. Outside of things like, I don't know, long-term utility contracts or something, it really changes the risk profile of the business.
Okay, so let's dig into how that $15 billion backlog actually gets built. How does the business model work day to day?
Right. Well, the whole thing is structured around two core segments. They're distinct, but they work together really, really well. Synergistic, you could say.
Okay, segment one.
First up is the funeral segment. This is, your classic funeral home business. It's actually the slightly larger piece of the pie for them, making up about 56% of their total revenue back in 2023.
And this covers the main professional services, right? Like preparing the body, use of the facilities, the staff, helping arrange everything, directing the service.
Exactly, all those high-value services. And the money comes in basically in two main ways.
Okay.
You've got at-need sales. That's what most people probably think of first. Someone passes away. The family needs services immediately. They make the call.
The immediate need.
But increasingly, a big chunk of that funeral revenue comes from fulfilling those pre-funded contracts, the ones that make up that $15 billion backlog we talked about, sold years, maybe decades before.
Okay, so funeral is one pillar. What's the other?
The second pillar, which brought in around 44% of revenue in 2023, is the cemetery segment.
Ah, the real estate side.
Pretty much.
Yeah.
This is about selling interment rights. So the actual physical property, burial plots in the ground, spaces in a mausoleum building, or those specialized niches they have for cremation urns.
And it also includes the merchandise tied to that, like the grave markers, headstones, maybe burial vaults.
Exactly. Markers, vaults, that kind of thing. Now, what's really important here is that the cemetery business, by its nature, is kind of perfectly set up for pre-need sales.
How so?
Well, while you can prearrange your funeral service itself, buying a cemetery plot often feels more like a long-term asset purchase to people, like buying a piece of property. It makes it, relatively speaking, an easier sell to get customers to lock that in and pay for it up front.
Which then flows into those trust funds and builds the backlog.
Precisely. It feeds that stability engine.
But the real clever part, it seems, is how they link these two segments together. You mentioned synergy.
Ah, yes, the integration, what they internally call combination facilities. This is where they actually build or locate a funeral home right there on the grounds of one of their cemeteries.
So for the customer, it's like a one-stop shop. Everything in one place during a really difficult time. That must be a big draw.
Huge convenience factor, absolutely. But for SCI, from a business perspective, it's an absolute profit machine. Think about the efficiencies.
Shared resources.
Totally. You can have one management team overseeing both operations. Shared grounds, maintenance crews, shared administrative staff handling HR, accounting, even things like utilities for the whole complex.
Cuts down overhead significantly, I imagine.
Massively. The source material we looked at, I think it was from a 2022 presentation, said that 61% over half of SCI cemeteries already had this integrated funeral home model.
Wow, 61%.
And that operational efficiency, that scale advantage at the local level, allows them to hit profit margins that a standalone independent funeral home or cemetery just can't realistically achieve.
So that integration itself becomes a kind of competitive advantage, a moat.
Definitely a moat. It makes it really hard for smaller players to compete on cost or convenience in those combined locations.
Okay, so they have this efficient, integrated model. But you said earlier the market is fragmented. How does that play into their growth strategy?
Right. This massive integrated company isn't just sitting still in a mature market. That fragmentation is actually the fuel for one of its main growth engines. Remember, SCI leads with about 16% market share.
Which sounds like a lot.
It is, but get this, approximately 75%, three-quarters, of the entire U.S. death care market is still made up of small independent businesses. Many are family-owned, maybe for generations.
The 75%, that's staggering fragmentation for an industry this size.
It really is. And that is what creates this incredibly long runway for growth for SCI. Unlike industries that are already heavily consolidated, where finding good acquisition targets is tough and expensive.
They've got thousands of potential options.
Literally thousands. And why are these small guys selling? Well, often it's a succession issue, right? The kids or grandkids don't want to take over the family business.
Or maybe they just can't afford the upkeep.
That's a big one, too. Maybe they need huge capital investments to modernize facilities or upgrade technology or deal with increasing regulations. Things SCI, with its scale and capital access, can handle much more easily.
So this fragmentation enables that roll-up strategy you mentioned.
Exactly. It's the classic roll-up playbook. They aren't just buying random companies anywhere. They're strategically buying to increase their density in key cities and metropolitan areas where they already have a presence.
Why is density so important?
Because when they buy a small, independent funeral home in a city where they already operate, say, 3 or 4 other locations and maybe a cemetery, bam, they can immediately plug that new acquisition into their existing network.
More cost savings.
Instant synergies. They fold it into their centralized back office systems for accounting, HR, purchasing. They leverage their regional management. They use their superior purchasing power for supplies. It makes the acquired business more profitable almost overnight.
And they're actively doing this. It's not just theoretical.
Oh, they are relentless. This M&A commitment is real dollars going out the door consistently. Just look at 2024 figures. They deployed $181 million to buy 26 funeral homes and 6 cemeteries.
$181 million in 1 year. That's significant capital.
It shows that consistent, disciplined deployment. They're focused on eating up that fragmented 75% piece by piece year after year. That's a core part of how they plan to hit that 8-12% long-term growth target we'll talk more about.
Okay, so you combine the efficient combo facilities with this aggressive acquisition strategy.
Right.
You really start to see how hard it is for anyone else to compete, especially the small independents.
Absolutely. The competitive advantages, the moats, they start stacking up.
What are the main ones?
Well, the first and most obvious is just sheer scale and cost efficiency. Because SCI is so enormous, their buying power for everything, caskets and bombing fluids, vehicles, you name it, is just unmatched.
Bulk discounts the little guys can't get.
Exactly. And then there are the centralized functions. Think about compliance, HR, legal, accounting. Managing all that for nearly 2,000 locations is complex.
Yeah.
But doing it centrally creates massive cost efficiencies compared to every small firm having to manage it all themselves.
That scale advantage crushes the operating costs of the local mom and pop, I bet.
It really does. Second big advantage.
Yeah.
Brand strength.
Dignity Memorial.
That's the one. Look, when you're making this kind of purchase, High stakes, incredibly emotional, often unexpected trust is absolutely paramount. The National Dignity Memorial brand is advertised, it's recognized, it conveys a certain level of professionalism, consistency, and reliability.
People know what they're getting, roughly.
Right, and that brand consistency allows SCI to command a degree of pricing power across its vast network, over 1,900 locations spread across 44 U.S. states and 8 Canadian provinces. That reach is enormous.
Okay, scale brand. What else?
Third, and this one is really proactive, is their pre-need sales force. This isn't just a couple of funeral directors taking calls. We're talking about a dedicated, professional sales organization of roughly 4,000 people.
4,000 salespeople focused just on pre-need.
Yep. Their entire mission is to go out and proactively capture future market share, convince people like you and me to sit down, plan our arrangements, and crucially, fund them years or even decades in advance.
That's a sophisticated sales machine that an independent operator just wouldn't have, right?
Rarely, if ever. They might do some pre-need, but not with this kind of dedicated, professional, outbound sales engine working constantly to lock in future business. It's a huge structural advantage.
Makes sense. And the last advantage.
Finally, let's talk about high barriers to entry, especially on the cemetery side of the business.
You mean it's hard to start a new one?
Extremely hard. Now, starting a basic funeral home might require moderate capital. Maybe you can rent a building. But trying to build a major new cemetery, particularly anywhere near a populated metropolitan area today, almost impossible.
Why? Land costs.
Land costs are huge, yes.
Mm.
But even more challenging are the regulatory hurdles. You're looking at years, sometimes decades, navigating incredibly complex local zoning laws, environmental impact studies, getting regulatory approvals, dealing with inevitable neighborhood opposition, not in my backyard.
Right. The MBY effect.
Exactly. So SCI's existing portfolio of nearly 500 cemeteries, many in prime locations acquired over decades, that's a truly scarce protected asset base. It effectively shields that part of their business from almost any significant new competition.
Okay, let's circle back to that giant number you mentioned earlier, the $15 billion pre-need backlog.
Yeah.
You said it's not just big, it actually changes the company's risk profile. How does that work?
Right, it's fundamental to their stability. So pre-need sales, just to recap, are where customers arrange and usually fully fund their funeral and cemetery services years ahead of time.
Why do people do this?
Lots of reasons. Mostly to reduce the financial burden on their families later, and also the emotional burden of making difficult decisions during a time of grief. Peace of mind, basically. And it's a big business for SCI. In 2023 alone, they generated about $2.6 billion just in new pre-need sales contracts. That's constantly feeding this backlog.
So they collect $2.6 billion in cash, but you said it doesn't hit their revenue right away. Let's unpack the accounting there, because that seems important.
Very important. When SCI collects that cash, it doesn't count as revenue on their main income statement yet. It sits on their balance sheet as a liability, basically deferred revenue.
A liability, even though they have the cash.
Yes, because they haven't delivered the service yet. Legally, those funds have to be protected. They're typically placed into trusts or sometimes used to buy specific types of life insurance policies. And those trusts have strict rules about how the money can be invested, usually in conservative things like bonds, fixed income securities.
Okay, so the cash is safe, invested.
Yeah.
When does it become actual revenue for SCI?
Only when they actually perform the service. So when the person who bought the pre-need contract passes away, SCI delivers the funeral, provides the cemetery plot, whatever was in the contract. At that point, they can finally recognize the revenue. They move it from the balance sheet liability over to the income statement as earned revenue.
Ah, okay. And this deferred nature leads directly to what you called the shock absorber function.
Exactly.
Yeah.
Think about that $15 billion sitting there. It's secured, it's contracted future revenue. So let's say next year we hit a really sharp recession and maybe fewer people are spending extra on elaborate at-need funerals. Or maybe we have an unusually mild flu season and mortality rates dip temporarily.
Their immediate at-need revenue might wobble a bit.
It might fluctuate, yeah.
Yeah.
But that $15 billion backlog, it's largely untouched by those short-term swings. It's just sitting there, waiting to mature into revenue as contracted services are performed over years and decades. It provides this incredible layer of insulation. It smooths out the bumps.
Makes the business far less volatile than it otherwise would be.
Hugely so. And that stability allows us to talk about something really interesting. The interest rate paradox.
Paradox. How so?
Well, think about when interest rates go up, like they have recently. What's the immediate impact on a company like SCI that carries a fair amount of debt?
Their interest expense goes up. Right. costs them more to service their corporate debt. That hurts profits in the short term.
Precisely. They've got about $5 billion in corporate debt, so higher rates mean higher interest payments hitting their quarterly income statement. That's the immediate sting.
Okay, so where's the paradox? Is there an upside?
There's a potentially massive hidden long-term upside. Remember where all that pre-need cash goes?
Yeah.
Into trusts invested primarily in fixed income.
Ah, so when interest rates go up, the returns on those invested trust funds also go up.
Exactly. Higher prevailing interest rates mean those huge pools of trust assets start generating higher returns over time. Now, here's the kicker. Regulations often allow these trusts to grow. If the investment returns on that trust principal over the many years or decades it sits there grow faster than the rate of inflation for funeral costs.
They end up with more money in the trust than they actually need to fulfill the original contract.
Precisely. A financial surplus profit is generated within the trust.
Yeah.
And that surplus, that extra money earned, it doesn't belong to the original customer's family. Upon the maturity of the contract, when the service is performed, that surplus profit accrues directly to SCI.
Wow. So higher interest rates are a double-edged sword, short-term pain on their corporate debt, but potentially a huge long-term gain on the massive pre-need trust investments.
It's a fascinating dynamic. They take an immediate, visible hit on debt servicing costs, but they're simultaneously building this compounding long-term tailwind from higher investment returns on the backlog that could deliver potentially billions in extra profit down the line. It ties their long-term profitability directly to macroeconomic interest rate policy in a really unique way.
Okay, so they have this incredibly stable foundation with the pre-need backlog and even a potential upside from interest rates. But it can't all be smooth sailing. We have to talk about the major headwind, that secular shift to cremation.
Yeah, you absolutely cannot ignore this. It's the core challenge the entire industry, including SCI, is constantly grappling with.
What's driving it so strongly?
It's a confluence of factors, really. Cost is a big one. Cremation is generally significantly cheaper than traditional burial, but it's also changing consumer preferences, a desire for simplicity, maybe less attachment to traditional burial plots, and importantly, declining religious prohibitions against cremation that used to exist.
And the trend is accelerating, right? It's not a slow drift.
Not at all. The numbers are pretty stark. The cremation rate in the U.S. was projected to hit 61.9% in 2024. That's already the majority. But the forecast is for it to climb dramatically higher, reaching almost 82.1% by the year 2045.
82%. That's basically becoming the default option.
Overwhelmingly so. And the reason this is such a headache for companies like SCI comes down to the price gap.
The difference in what people spend.
Exactly. We're fundamentally shifting from a generally higher price, more complex service package to one that could be much simpler and lower priced. A traditional burial with the casket, vault, cemetery plot, full service, they could easily run a family, what, $8,300 to $10,000, sometimes more.
Okay, and cremation?
Well, it varies. A cremation followed by a full memorial service might average around $6,280, still significant, but less than burial. But then you have the option of a direct cremation, no embalming, no viewing, no service, just the basic cremation process. That could be as low as $1,100.
Wow, $10,000 versus potentially $1,100. That's a massive difference in revenue per customer.
It's huge. And that disparity creates this constant underlying pressure on profit margins across the whole industry. If everyone just shifted to the $1,100 direct cremation option, the traditional funeral home business model would essentially break.
So SCI's ability to manage this, to somehow maintain margins despite this shift, must be absolutely critical to their success.
Non-negotiable. Their execution on pricing, service mix, and demonstrating value is everything here.
Which leads us to how they're actually fighting back. How do they mitigate this margin pressure? It seems like they have a specific strategy.
They do. This is where their internal operational execution really shines, creating what you could call a critical counter-narrative to the simple cremation equals lower profit story. Management is very clear. Their revenue growth isn't solely dependent on the number of services they perform. It's crucially about increasing the average revenue captured per service.
Getting more dollars from each customer, even if the base service is cremation.
Exactly. And we actually have recent data that shows this strategy is working. Let's look at some comparable sales figures from, say, Q2 2025.
Okay, what do they show?
Well, first, the number of comparable services performed. Basically, the volume actually went down year over year by 1.5%.
Okay, volume down. That reflects that post-pandemic normalization we talked about earlier, right? Fewer deaths than the anomaly years.
Precisely. Fewer people passing away compared to the peak pandemic period. But here's the really important metric that tells the other half of the story.
The average revenue per service.
You got it. In that exact same quarter where volume dipped 1.5%, the comparable funeral sales, the average amount spent per service actually increased by 3.1%.
Ah, so volume down slightly, but price per service up significantly more. They're more than offsetting the volume dip with higher revenue per case.
That divergence is the proof point. It shows the strategy in action. They're successfully counteracting lower volume by getting customers to spend more per transaction.
How do they manage that, especially when cremation itself is cheaper? Isn't it a tough sell?
It requires skill, definitely. It's about shifting the focus. They try to move the conversation away from just the method of disposition, burial versus cremation and towards the idea of creating a meaningful celebration of life.
So upselling and adding value around the core service.
Exactly. They offer differentiated cremation packages. Maybe it includes a nicer urn, a memorial service in one of their chapels, catering services, personalized video tributes, keepsakes. They focus on personalization and making the event unique.
So they're essentially arguing, okay, you chose cremation, which might save some money on the core disposition, but let's make the memorial service itself a really special, high-value event.
That's the pitch. It's about convincing families that even if the underlying method is changing and potentially less expensive, the surrounding emotional, ritualistic, and commemorative components should still be invested in. That focus on service quality, personalization, and upselling higher value packages is precisely how they aim to maintain and even grow average revenue per case, despite the undeniable pressure from that basic $1,100 direct cremation option.
We should also probably touch on the recent volatility caused by the pandemic, just to provide context for some of the year-over-year numbers people might see.
Absolutely, it's crucial context. Fiscal year 2021 was a huge anomaly for the entire industry, especially SCI. We saw that massive, tragic surge in excess deaths due to COVID-19.
Which, from a purely business perspective, meant a temporary surge in revenue and profits for them.
A significant but obviously tragic boon. But it created an incredibly high benchmark, making comparisons in the following years look weak.
And now we're seeing the other side of that, the normalization effect.
Right. Some of the deaths that occurred during the peak pandemic years might have otherwise happened naturally in 2023, 2024, or even 2025. It's often called the pull-forward effect. The pandemic essentially borrowed some volume from the future.
So as things normalize, the total number of deaths is actually dipping temporarily below the long-term trend line through 2025.
Exactly. And that's why you see reported figures like that decline in services performed in late 2024 or early 2025. It's not necessarily a sign of underlying business weakness. It's largely an echo effect from the pandemic disruption.
But management's argument is that even with this normalization, they're operating at a higher level than before the pandemic.
That's their key point. They argue they've established a new higher earnings base. If you compare their current key metrics, revenue, operating income, cash flow, not to the peak of 2021, but to the pre-pandemic levels of, say, FY 2020, they are substantially higher.
So they believe they used the pandemic period effectively, gained market share, improved efficiencies.
That seems to be the narrative. They solidified market share, drove significant operational efficiencies through things like technology adoption and centralization, and emerged from that difficult period onto a higher permanent platform for earnings and cash flow generation. The short-term dips now are just noise around that higher base.
Okay, so looking past that pandemic noise, management seems pretty confident about the future. What's their long-term growth plan?
They're remarkably clear and, frankly, quite ambitious about it, especially for what many might see as a mature service industry. Their core financial goal, the central target they communicate to investors, is achieving 8% to 12% annual growth in adjusted earnings per share, EPS, over the long term.
8 to 12% EPS growth per year consistently? That's pretty strong.
It is. It tells you they really believe that the combination of the demographic tailwind, the aging population, and the opportunity for market fragmentation gives them a unique, extended growth runway.
And do they break down how they expect to hit that 8-12% target? Where does the growth actually come from?
Yes, they're quite explicit about the sources, showing it's a balanced approach. It relies on both those engines we discussed earlier, organic improvement and capital deployment.
Okay, so how much comes from organic growth?
They attribute roughly 5% to 7% of that annual EPS growth target to organic growth. This is the internal engine humming along. It comes from pushing that average revenue per case higher through pricing and better service mix.
The celebration of life strategy we talked about.
Exactly. Plus, continued robust growth in pre-need cemetery sales, which tend to be higher margin. So getting more from their existing assets and customer interactions.
Okay, that's 5-7%. Where does the rest of the 8-12% come from?
The remaining 3% to 5% is expected to come from smart capital deployment. This is primarily the external engine that M&A roll-up strategy.
Buying more independent firms.
Right. But crucially, doing it accretively. That means the acquisitions they make are expected to immediately add to earnings per share, not dilute it. They combine this M&A activity with ongoing, steady share repurchases.
Buying back their own stock.
Yeah. By reducing the total number of shares outstanding, the same amount of total earnings gets divided by fewer shares, which automatically boosts the earnings per share number. It's another lever they consistently pull to help hit that overall 8-12% EPS growth target.
It's interesting for a business that deals with something so traditional, so fundamentally human and emotional, how much they seem to be investing in technology and digital tools.
It's actually one of the more surprising aspects, isn't it? You might not expect it. They're making significant capital commitments here.
How significant?
Well, for 2025, they budgeted around $25 million, specifically for digital investments and related capital expenditures. That's a serious commitment. And their stated goal for this spending is quite modern, to provide a convenient, streamlined, and effective buying experience.
Meaning people might start the process online?
Increasingly, yes. The idea is that a customer should be able to research options, understand pricing, maybe even begin making arrangements digitally before they ever need to physically walk into a funeral home or cemetery office. It's about meeting customers where they are, which today is often online first.
And how does this tech investment translate into actual business results, particularly in marketing and sales?
They're using some pretty sophisticated tools. For instance, they've implemented a customer data platform, or a CDP. This is basically a system that pulls together all the different data points they have about potential and existing customers into one unified view.
What does that allow them to do?
It enables things like website personalization at scale. So depending on who you are and what you've looked at before, the website might show you different information or highlight different packages. It allows much more targeted marketing, especially for pre-need leads.
And does it work?
Apparently so. They've reported that this kind of personalized digital outreach has led to increases in online conversion rates. People taking a desired action, like requesting more information by up to 43% in some cases.
43% increase in conversions. That's huge.
It is. And that CDP system doesn't just generate leads, it also intelligently routes those leads to the right salesperson within that massive 4,000-person pre-need team. Based on geography, expertise, or availability, it makes the whole sales process much more efficient.
So tech isn't just for the customer-facing side, it's also driving internal efficiency.
Absolutely. It's not just about slick websites. It's about operational efficiency across their enormous physical footprint. A great example is an IT partnership they formed with a company called Avanti.
What did that involve?
It involved implementing automated self-healing bots and enhanced remote support tools across all their 1,900-plus locations.
Self-healing bots? That sounds pretty futuristic for a funeral home network.
It does, but the practical impact is very tangible. It means many common IT problems, issues with point-of-sale systems in a funeral home, network connectivity problems, software glitches on employee computers can often be detected and fixed automatically by the software bots or fixed quickly by remote IT staff without needing to dispatch a technician.
Which saves time and money.
A lot of both.
Right.
Think about the logistics of supporting IT across thousands of locations in nearly every state in Canada, minimizing employee downtime waiting for tech support, and avoiding the cost of sending IT people out physically. They estimate this initiative alone is generating nearly $1 million in annual cost savings. And it also improves employee productivity and morale because staff aren't stuck unable to do their jobs due to tech issues. It's a perfect illustration of how SCI leverages its scale investing in sophisticated technology that a small independent operator could never afford to drive real bottom-line efficiencies.
Okay, let's shift gears a bit and look at the financial structure that supports all this, the M&A, the digital spending, the dividends. How is the company capitalized?
Well, as we touched on briefly, SCI definitely uses leverage. It operates with a leveraged capital structure. Their total debt is around $5.03 billion.
$5 billion. That sounds like a lot for a service business. Is that a major risk?
It's certainly something investors need to be aware of and monitor. High debt always introduces financial risk. However, management seems quite disciplined about managing it. They have the publicly stated target range for their key leverage ratio, net debt to EBITDA, of 3.5x to 4.0x.
And where are they within that range currently?
As of their latest reporting, around March 2025, they were sitting at 3.5x, right at the low end of their target range. So they're managing it within their own stated comfort zone.
Why is that level of debt considered manageable for them? What makes it different?
It really comes down to the predictability and strength of their earnings and cash flow. Remember that $15 billion backlog and the non-cyclical nature of the business? That generates very robust and reliable free cash flow. They generated $556 million in free cash flow in fiscal year 2024 alone.
And that cash flow covers the debt payments comfortably.
Yes. Their interest coverage ratio, a measure of how easily their operating income covers their interest expense, was recently around 3.7x. That suggests that even with the recent rise in interest rates, their cash generation is more than sufficient to handle their debt servicing obligations. The predictability of the underlying business supports the debt load.
Okay, so they generate a lot of cash. Over $2.7 billion in free cash flow just from 2020 to 2024, you said. That's a huge amount. How do they decide what to do with all that cash? What's their allocation philosophy?
They're pretty clear and consistent about this. They follow a very balanced approach, aiming to deploy that cash in ways that both fuel future growth and return value directly to shareholders.
So not just hoarding it or only investing in growth.
No, it's a mix. If we look at the actual data from FY 2024, it illustrates this balance really well.
Okay, what did they spend it on?
Well, first, they put $181.0 million towards acquisitions. That directly funds the external growth engine, the roll-up strategy we discussed, buying those independent firms.
First, fueling future growth. What else?
Second, they dedicated a significant chunk, $249.8 million, to share repurchases.
Buying back their own stock again. Why is that a priority?
It's a tax-efficient way to return capital to shareholders, and as we discussed, it mechanically boosts earnings per share by reducing the share count. This directly supports achieving that 8-12% long-term EPS growth target. They do this pretty consistently.
Okay, acquisitions, share buybacks. What
Yeah.
about dividends?
Yes. Third, they paid out approximately $170.0 million in dividends to shareholders in FY 2024. They have a stated target payout ratio. The percentage of their earnings they pay out is dividends of just 30% to 40% of their after-tax earnings.
30 to 40%, that sounds quite conservative, doesn't it? Paying out less than half their earnings?
It is conservative.
Okay.
And that's key for dividend investors. It means the dividend is very well covered by earnings, providing a high degree of safety and sustainability. It also leaves plenty of room for future dividend increases, like the recent raise to 0.32 cents per share quarterly. That conservative payout ratio, combined with the stable cash flows, makes the dividend look very secure.
This all brings us back then to the really central question we started with, that valuation premium. Why does the market value SCI so much higher than its competitors?
It's a stark difference, isn't it? When you look at their publicly traded peers, companies like Carriage Services, maybe Matthews International, parts of Hillenbrand, they all operate in broadly similar spaces.
But SCI trades at a much higher multiple.
It's much higher. SCI's forward price to earnings PE ratio is typically hovering around 21.5x, its closest competitors. They're often trading in a range closer to 9.0x to maybe 12.0x forward PE.
That's nearly double the valuation multiple in some cases. How is that justified?
I think the market is essentially recognizing and pricing in several key factors where SCI is just fundamentally different and superior to its peers. Factors they simply can't replicate easily.
Like what?
Well, first, it's that unmatched scale and the resulting operational efficiencies and cost advantages we've talked about. Nobody else comes close. Second, it's the proven consistency of their operational execution, particularly in successfully navigating that huge cremation headwind through pricing and service mix. They've shown they can do it.
But the biggest factor has to be the backlog, right?
I think that's the cornerstone of the premium valuation. That $15 billion pre-need backlog is the ultimate differentiator. It provides a level of secured, contractual future revenue visibility and stability that is just unparalleled in the industry.
So the market sees less risk.
Exactly. Yeah. It dramatically reduces the perceived business risk associated with economic cycles or those short-term fluctuations in mortality rates. So that high valuation, that 21.5x PE multiple, it's effectively the market signaling very high confidence.
Confidence in what specifically?
Confidence that SCI is not only well defended against macroeconomic instability, but also that it's highly likely to actually achieve that ambitious 8-12% long-term EPS growth target they've set out. The premium says the market believes the quality, The durability and the predictability of SCI's earnings stream are just fundamentally superior to anything its competitors can offer. They're paying up for certainty and growth.
Okay, that makes sense. So for you, the listener, trying to process all this information, let's try to synthesize it. Maybe we can look at SCI through the lenses of three different types of investors, because what makes this company potentially appealing really depends on what your investment goals are.
That's a great way to frame it. Let's start with the classic value investor.
Okay, the value investor. What would attract them here? They're usually looking for bargains, undervalued assets, safety.
Well, the safety aspect is huge. The non-cyclical nature of demand is the prime attraction. It ensures incredible durability and predictability of the underlying business and its cash flows. They're betting on the fact that this business isn't going away, and demand is guaranteed.
And are there potentially undervalued assets on the books, things the market might be missing? Value investors love hidden assets.
Absolutely. There are two big ones here. First, that $15 billion pre-need backlog itself. While it's a liability on the balance sheet until services are performed, it represents a massive pool of future profit and cash flow. You could argue its true economic value isn't fully captured in standard accounting. It acts almost like a hidden internal financing mechanism.
Okay, the backlog. What's the second hidden asset?
The real estate. SCI owns this vast portfolio, nearly 500 cemeteries, over 1,400 funeral homes. Many of these properties, especially the cemeteries in established urban or suburban areas, were acquired decades ago.
And are probably worth a lot more now.
Likely far, far more than their historical book value listed on the balance sheet. Given the incredibly high barriers to creating new cemeteries, the replacement cost of that strategically located land portfolio is probably enormous. That's a significant source of underlying, potentially underappreciated, intrinsic value.
Makes sense. But what's the main concern for a value investor looking at SCI? Is there a catch?
The primary concern has to be the debt. That $5.03 billion in corporate debt is substantial. Even though we've argued it's manageable due to the stable cash flows, a value investor performing their own intrinsic value calculation, maybe using discounted cash flow models, absolutely must meticulously account for that heavy debt load. It impacts the final valuation.
Okay, that's the value perspective. What about the income investor? Someone focused purely on dividend secure, reliable, hopefully growing income streams.
For the income investor, SCI presents a very compelling case, I think, based primarily on sustainability and growth potential.
Sustainability first, how secure is that dividend?
Extremely secure, based on two key factors we've discussed. First, the underlying free cash flow is incredibly stable and predictable, insulated from economic cycles by the nature of the business and that backlog. Second, their own conservative payout target of only 30% to 40% of after-tax earnings.
That low payout ratio gives them a big cushion, right? Even if earnings dip temporarily, they can easily afford to maintain the dividend.
Exactly. It provides a massive margin of safety for the dividend payment. But income investors don't just want safety. They usually want growth, too.
Does SCI offer dividend growth potential?
Yes, and here's where that long-term 8% to 12% annual EPS growth target becomes really important for the income investor. That target provides a clear, defined pathway for future dividend increases. If earnings are growing consistently at that rate, it's highly likely that dividend payouts will also grow consistently, probably outpacing inflation year after year.
So it's not just a stable dividend, but one with a high probability of meaningful future growth baked in by the company's overall strategy.
Precisely. Stable base, clear growth path. That's often exactly what income investors are looking for.
All right, finally, let's consider the growth investor. They're usually looking for companies with significant expansion potential, often in newer industries. A death care company might not seem like an obvious fit. What's the growth thesis here?
You're right, it's not a tech stock. But for a growth investor willing to look at more mature industries, the SCI thesis has to rest on really powerful, almost undeniable long-term non-cyclical trends that go beyond typical market noise or economic cycles.
And you said there are two main pillars supporting this growth story.
Two pillars, yes, that are almost guaranteed to provide tailwinds for years, maybe decades to come. Pillar number one is pure demographics.
The aging of the population.
Exactly. Forget the short-term post-pandemic normalization. Look out over the next 10, 15, 20 years. We have the entire massive baby boomer generation moving through the age structure. This demographic wave is projected to drive a steady, substantial increase in the absolute number of deaths occurring each year in North America, really kicking in after 2025 and continuing for maybe 2 decades.
So this isn't speculative growth based on a new product hitting. It's a fundamental increase in the total addressable market volume, driven by demographic certainty.
It's about as certain as forecasting gets. That provides a massive underlying volume driver for the entire industry and especially for the market leader. But volume isn't the only growth engine here.
What's the second pillar for the growth investor?
Pillar number 2 is consolidation. The growth investor has to love the fact that 75% of this huge market remains fragmented.
So the M&A runway.
It guarantees decades of opportunity for SCI to continue executing its roll-up strategy, making accretive tuck-in acquisitions. They don't need to invent a new market or find entirely new customers beyond the ones demographics will deliver. They can grow significantly just by continuing to buy up existing businesses and plugging them into their efficient platform.
So the growth story isn't about disruptive innovation. It's about demographic waves plus systematic consolidation of a fragmented market.
That's the core thesis. Those two powerful, almost guaranteed trends, the rising tide of demographic volume and the vast ocean of consolidation opportunities, are the fundamental forces that underpin the credibility of that ambitious 8–12% annual EPS growth target. That's what a growth investor would likely focus on.
Okay, so wrapping up our deep dive into Service Corporation International today, what we've seen is, well, a really impressive example of defensive strategy execution. They're the dominant player in a non-cyclical market, and they seem to be managing the short-term noise, like post-pandemic volatility, through sheer operational efficiency.
Yeah, and critically, they are actively and seemingly successfully offsetting that enormous long-term headwind from the rise of cremation. They're doing it by relentlessly focusing on things like pricing power, service personalization, and upselling those higher value celebration of life packages.
And underpinning it all is that financial stability, that visibility provided by the $15 billion pre-need backlog. It really does seem to shield them from the kind of volatility that hits most other service companies.
Absolutely. You combine that backlog shield with their unmatched scale, their brand strength, and that relentless M&A roll-up strategy, and you really start to understand why the market is willing to grant them that significant valuation premium over their peers. It seems earned based on their unique position and execution.
So let's leave you, our listener, with a final provocative thought to mull over. We know the fundamental volume of the death care market, the sheer number of people needing services, is virtually guaranteed to rise substantially over the next 20 years, thanks to demographics. That part isn't really in question.
Right. The volume increase is baked in.
So the crucial question for SCI's future profitability and for justifying that premium valuation long term isn't really if people will need their services. It's how successful SCI will continue to be in convincing grieving families to spend significantly more money on differentiated service packages. Those personalized events, specialized memorial products, unique commemoration options, even as the underlying physical method of disposition, cremation, becomes overwhelmingly dominant and inherently lower margin.
Can they keep selling the value of the experience, not just the basic process?
Exactly. Their long-term success seems to hinge entirely on their continued ability to sell higher value, richer experiences and personalization, effectively decoupling the total revenue per customer from the falling cost of the basic disposition method. That's the strategic tightrope they have to walk.